Hello and good day to everyone. I'm having a flu right now, so you will find that I sound a little bit weird. In today's Growing of Prosperity, I'm going to talk a bit about this thing known as the permanent portfolio, and let us find out what it is. Okay. And this permanent portfolio is invented by this guy called Harry Browne. And his idea is to split your portfolio into four equal parts. One in stocks, one in bonds, one in gold, and one in cash. Rebalancing is going to be done once a year. And the trend for the permanent portfolio come and go, but it's been featured in this week's Economist that came out last week, Friday, 3rd of October, 2025. And this is one of those portfolios that are featured when markets become a little bit unstable. For example, you're worried about AI crashing, you can always structure your portfolio this way because it is relatively safe. All right. Okay, so Harry Brown's rationale for the portfolio is actually quite interesting. His idea is there is one asset class that will do well in any of the phases of the market cycle, right? If the economy is in expansion, equities and stocks do very well. Where the economy is facing a lot of inflation, there's a lot of money printing, gold would do very well. And then when periods are deflating, right, where you see inflation become negative, bonds tend to outperform in such a market. And finally, when there is a recession or else fails, cash would perform very well. Cash doesn't move, so cash would do well relative to the rest. All right, and you can enjoy the Pearson correlation heat map that I've built regarding the four asset classes. And you find that the average numbers in each cell is relatively low, which means that these instruments are designed not to do well when another instrument is doing well. All right, so the overall correlation is quite low. Okay, so what we are going to do is we want to look at the 10-year performance of first of all, the global variant of the permanent portfolio, and that is VT, BNDW, gold, and SHV, right? Short treasury bonds is the closest thing to a money market fund that I can find. So you can use this combination of four. Okay, alternatively, if you are biased towards the United States, then you can pick up SPY, AGG, GLD, and SHV. Okay, and you can research these ETFs. They are all relatively cheap. Okay, for savvy investors, you can always find the equivalent UCITS ETFs traded on the London Stock Exchange. All right, you can improve your performance slightly. Okay, let's look at the returns for the global variant, right? If you observe the returns for the global variant, you will find that the return is not bad, 7.8% for the past 10 years annualized. And what is amazing is the low standard deviation, right? You have a standard deviation that is only 6.66%. It's almost like a third of what equity buyers perceive, all right? All right. Slight negative skew, okay, that can't be helped. Most portfolios have a negative skew, all right, and a decent Sharpe ratio, 1.177, okay. And the maximum drawdown is about 13.36%. And that's very good because most equity portfolios, the maximum drawdown is 30 to 40%. So this is really one of those portfolios that let you sleep well at night. Now, what happens if we were to replace the equity and bond variants with a US variant? So we have the Standard & Poor 500 and the US government bond, right? You find that the annual return doesn't really change, right? The standard deviation is slightly lower, so you end up with a higher Sharpe ratio. And you got a slightly lower maximum drawdown, all right? This probably explains why the economists decided to feature this strategy, right? So this concept is very good because the performance is very consistent when you benchmark against each other. Yeah, but that's not all, right? We can have a Singapore variant, and the Singapore variant is the Straits Times Index with the Singapore Bond Index Fund. We have a gold ETF that we can buy from SGX. And Philips has a money market fund denominated in Singapore dollars. So we could backtest that as well. And lo and behold, our return is about 7.85%. The risk is higher. Okay, so our Sharpe ratio is a little bit lower, but the drawdown remains fairly reasonable at negative 17%. Right. So with that, right, let's summarize the permanent portfolio. Okay, it is a portfolio that is easy to understand, easy to execute, right? And over the long term, you can expect 7% every year, which is not too bad. The low standard deviation lets you sleep very well at night because you're taking a risk that is very low compared to your peers, okay? And it's got a very low drawdown, okay? So this is really something for people that want to play it safe. And I think playing it safe this way is probably much better than any of the ILP offerings or an endowment offering, okay? So this is a very good way to start. The disadvantages is that there are long periods of underperformance relative to stocks, right? Because 25% of the portfolio you're holding on to cash. So you cannot expect this portfolio to do fantastically well, right? The only reason why right now it's doing well is because both gold and stocks are doing rather well in the US stock market, right? But most of the time, right, the 25% that you put into the money market fund, it is some sort of a cash trap on your portfolio. So because of this, the popularity of the strategy comes and goes. Okay, and this is something that you want to do if you anticipate an AI bubble forming. So this is a short video. If you want to help me Google ERM intro, take the first link and come for my next preview, right? Otherwise, you can buy me a coffee here. And this video is very short, and that's it. Thank you very much.